Hey everyone, we got a real interesting podcast in store for you today. Some fascinating stuff. You're probably not going to hear it, rarely hear it anywhere in the industry. We hope so, or hope so. But we got some things we're going to talk about two different mindsets, about how most people, myself included, and a lot of people approach trading the markets and in a unique, different way. So we hope that you find it really interesting in your trading journey and endeavors to be valuable and worth your time. So my name is Chad Shirley, and I'll be your host today. And as always, we're going to have Ryan Jones as our
Hey
permanent
everyone.
guest. Ryan, say hi. But before we get started in today's topic, man, the markets have really been kind of going crazy and screaming higher. Up 22, 23% in the last 3.5, 4 months. What's your make of all this, Ryan? What's your 2 cents, man?
Oh man, you talk about crazy. I was bullish the last 3 months of the year, just from the seasonal standpoint. And the market was setting up, and sure enough, the market went up. But then, January, I'm starting to look for a pullback. January, February, start to look for a pullback.
Right.
And I kid you not, Chad, in my live trade calls every week for the last 8 weeks, I've been saying, okay, we're going to set up for a move to the downside. And
Right.
every week since that, the market's gone up. It's been ridiculous. So yeah, it's actually hit 25% from the lows in late October or mid October, which is it's unsustainable.
Right.
I mean, yeah, I mean this is an electric election year, right?
Mhm.
So it's going to be bullish. That's
Yep.
election years are generally bullish. But this is insane, and it's being propped up. And I keep telling everybody, you know what? There's going to be a retracement coming. So I'm going to stick to my guns on
Yeah.
that, and I'm going to
Yeah.
say, this is just unsustainable for the rest of the year. You can't go up 25% in 4 months, 4.5 months now, and I think that's what it hit. I think the high the other day, I think yesterday actually, or no, the day before yesterday, the high had hit 25% from the low
Yeah.
in 4.5 months. So that's what I think. I think we're due for a retracement, and in my live trade calls, I'm setting up for these bearish trades, but I'm covering my risks to the upside in case I'm wrong, and I've been wrong 8 weeks in a row. So,
Yeah. So you're still surviving though.
oh yeah, we're actually up during that 8 weeks because I put on these hedge trades. So I'm not a market direct, and I guess that's going to kind of get into the topic today because I'm not a direction picker. Even though I'm picking a direction,
Right.
I don't marry that direction. I don't like take a bearish trade and then say, okay, if I'm wrong, I lose. I
Right.
take a bearish trade and I say, okay, if I'm wrong, I've got this other trade that's going to save my butt, type deal.
Yep.
Right. So
Yep.
that's kind of my philosophy, but that kind of goes into the two basic types of mindsets that traders go into, um, which
Yeah.
you trade differently than I trade, right? I mean,
Right.
we've known each other for a long stinging time,
Right.
and you've always your mindset. I know your personality. You're just different than how I approach trading. So how do you approach trading?
Right. So for me, a big portion of what I do, and I've been, trading like professionally and non-professionally and been a financial advisor, but I've been doing this for about 25 years, at low levels to high levels. So a good majority of what I personally do is I do try to pick direction with a good majority of my risk capital. So what I do and what I know most everybody that I know out there, or the majority of people, is we try to pick direction. So what I mean by that too is there's a lot of quantitative things that we can know and learn on the internet or study on our own, but it's that qualitative part that took me a long time to figure out. And what I mean by that is when I try to pick direction, I'm wrong definitely more than I am right.
Yeah, and
So,
that's totally normal.
and that's hard to get used to.
Yeah,
It's
yeah,
hard to get used to. So when I'm trying to pick direction, what I mean by that is like I may risk, keep life super simple, $1 to make $2. Well, and I'm bullish in that scenario. The market conditions, when they're conducive to that, I might hit that target 2 out of 3 times.
yeah,
When the
yeah,
markets are sinking, in sync with my model. However, when the markets shift or change or go the other direction, I might be 1 out of 3, right?
Yeah.
So when you blend that over different market cycles and changes and dynamics, I'm probably 50-50 or actually less than that. My analytics are probably 45% over hundreds and hundreds or thousands of trades, and my risk to reward multiple is a little bit over 2%. So it's what it's very hard for people to do in real life, in the truth and the reality of this, of how we all got started, how you probably got started 40 years ago, maybe.
Yep.
You can
Yep.
maybe get into that, and other people, is we try to pick direction, but people do not understand streaks. And I don't want to get all analytical
Oh,
and
you're
mathematical,
you're going
but you
right
got
down
to
my
be
alley right
prepared to
now.
lose 10, 15 times in a row, possibly. And you as a human being, you're going to quit
Yeah.
mostly at first and second, and you're going to reassess your model. So the point is it took me a long time to get there. I still do some high probability things like you do, Ryan, but you're on a different level of thinking that I am, per se, and it works for you. And I think you realize that the trading style I mentioned, which works for me over the long run, is not really for you. And you might want to explain why that is. And it does make
Yeah.
logical sense.
You hit on, I think, the thing that bothers me the most with that type of approach. And it's not wrong or right. There's no
Right.
wrong or right. If you're making money, you're making money. That's the end goal for everyone. The question is, what can you do? And I'm just going to tell you right now, like you said, I started, gosh, it's been 35 years, not 40. I'm not that old, Chad.
Yeah.
35 years ago.
Yeah. Yeah. Yeah.
And I started, with market direction because that's what the industry pushes you for. In fact, I'm going to get off on a little bit of a tangent here, and you have to bear with me.
Yeah.
But the industry kind of sets it up, and this is the way they sell it: that if you can pick market direction, you're brilliant, you're a genius, you're smart,
Right.
and if you
Right.
can't, you're dumb. And who wants to be dumb, right? So we spend just an inordinate amount of time trying to figure out how to accurately pick market direction. And the best of the best, uh, are not going to be able to do it without some losing streaks, some serious losing streaks,
Right.
even if they're, right, 60% of the time. And usually, those types of traders are trying to pick the trend, right? So
Right.
their winners are going to be larger than their losses are going to be. And then they're going to generally, like you said, they're going to win about 45% of the time. And they're going to lose, 55-60% of the time. That's pretty standard on that type of, trend following. You go all the way back to Paul Tudor Jones and the
Yeah.
Turtles. And that's what they were doing. They were picking trends, and they were taking, smaller losses. But when they hit on a whale, they hit on a whale, and they just
Right.
rode it. And that's very, very difficult to do because you're pulling out losses. Let me tell you the mentality. I've analyzed this 1,000 times over.
Yeah.
You're taking some losses. You're taking some losses, and finally you get a winner. And you're like, you don't want to see this turn around and turn into a loss. And so you get out. You get out way before you should.
Amen.
That's I found myself doing that over and over. And finally I just said, you know what? This is for the birds. I just don't like being wrong. There are two things in life that I hate. The first is losing, and the second is losing. So with me, it
Yeah.
was a mental game. It was a struggle,
Yep.
and it was not fun. I'm just gonna, I hated it.
Yeah.
Um, and I decided long ago that that's not how I was gonna pursue my trading career. And so I did. I moved over into how can I win more
Hmm.
and not deal with the psychological stress of
Right.
losing, 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 and then can I really take this next trade? What if I lose again and my drawdown, exceeds what it's exceeded in the past 2 years or whatever the case is, right? Very difficult to do. So those are the two major types of traders. You've got the ones that are looking to pick direction. They're looking for the bigger winners and taking smaller losses. To me, that it takes a certain personality, and it's not mine. And then you've got my personality, my type of personality, where if I need that affirmation to keep going and to be consistent, I have to have the wins. I have to have those. The problem, though, that everybody runs into
Yeah.
is the win-loss ratio, right? So you've got the probability aspect of it. Win 50% of the time. You can do that'd be great. If it was 1-to-1 win-loss ratio, you're a break even, right? It's the streaks though.
That's
Because
it.
at 50-50, every 1,000 trades, you're going to suffer a 10 losses in a row if you stick to the statistics. At 40%, it's like every 600 trades, you're going to at least go through 10 losses in a row. And the question is, can you survive that? Can your account survive that? Can your mentality survive that? I have difficult doing that. So, knowing the statistics and the streaks, I lean towards that. But then you have the flip side of it. Okay, well, what's my win loss ratio? Because if I'm 50% and 2-to-1, that's great. You're going to make money doing that. You make some good money doing that. That's better than the casino odds. Um,
Yep.
but then you take my mentality of approaching the markets, and I like to win a lot. And so people that are more like the way I approach it, they like to win a lot, and the industry pushes those people, those traders, into iron condors, credit spreads, things of that nature, where
Put
out of the
selling.
put selling out of the money, high probability, but then man, when a loss comes,
Wiped
that
out.
loss could wipe 10 winners out. And so that bothers me too. So I'm like,
Yeah.
trying to get the best of both worlds. And that's what I spent literally, I've spent my trading career trying to find the best of both worlds. And so I don't trade iron condors. You will not see me trade an iron condor. I do, they get into iron condors, you can have long winning streaks, and then boom, a couple of losses, and you're back to square one, and it's really frustrating. Um, and then you start getting into the management. Okay, so well, this is going into a loss, so how can I manage the legs of this trade now to kind of extend that probability out a little bit? It becomes very detailed and involved, and I don't like that either.
Yeah.
I'm very picky.
Oh yeah. One thing I'll kind of leave on the trend following thing, if people were to go back and study history of some of the greatest money managers in the world that on average netted their investors 20% a year annualized.
Yeah.
And you look at their 20, 30-year track record, Ryan, I don't know if people know this, but they have 30, 40, 50% drawdowns, peak to valley
Yes,
drawdowns, losses in a year. But they keep sticking with it. So most human beings may not do that in reality with their own accounts.
that's right.
And they don't know the truth that sometimes you might have to stomach 4, 5, 6, 7, 8 months of working for free. You're not
Yeah,
making any money.
yeah,
It takes 7, 8 months to get back to where you started. And they have losing years. They have a few here and there. If you look at the best guys in the world, but you have to have a different mindset to be that trend follower that you just mentioned.
yeah.
So most human beings don't have that capacity to stick with it truthfully and honestly.
Right.
I mean, I've never seen any evidence of anything different of somebody that makes money every month, every year for 30 years that's a trend follower, for example, trying to pick direction. I've just never seen it. I've never
Yeah.
done it. So it's just different psychologically. And to your point, I think you've got a lot of wisdom and you put in a lot of blood, sweat, and tears over the last 50,000 hours, I know.
Oh, oh yeah, it's been a passion, most
Mhm.
certainly, over the last 35 years, mainly because I hate losing. So it just drives me, right? So that's really what drove me. Um,
So
and
why do you do, Ron, let me ask you something. So why do you do this? You don't have to teach people. You don't have to spend time doing the business that you do to try to help. Why do you do this? I've talked to you about it before, but I think it's kind of interesting. And what's the
yeah,
point? You don't have to do it.
actually, I do have to do it.
Okay.
Because how do I say this? There's an accountability factor. When
Mhm.
I'm out there telling somebody, hey, this is what I'm doing, this is how to do it, this is what the risks are, this is, the potential that you can make from it. Um, and this is how to trade it. I better darn well know what I'm talking about because people are
Yeah.
relying on what I'm saying, right? So it actually drives me to find even better strategies than I would ever be motivated on my own to find. I'm not going to lie. I was a C average student. I just was not motivated in school. It was very boring to me.
Mhm.
And, I was hands on. And so I have to have some sort of motivation. And knowing that people are relying on my words or will at least take into consideration my words, it drives me. I would have never found the strategies
Yeah.
that I have found if I were just doing this on my own.
Yeah.
So it's just different when here's what you're doing
Mhm.
and no one else sees and you might spend a little bit of time here, a little bit of time there. You might spend a lot of time. But when you're being analyzed constantly,
Yeah.
man, it drives you. I'm telling you, it drives you. And
Because
so
you're probably being cross-examined by
I'm
pretty smart guys and
oh
gals.
yeah, yeah, cross-examined, and clients are, giving me feedback and um, if I suffer a losing streak, I'm in there, I'm like, oh man, my clients, if they're trading what I'm trading and they're going through this losing streak, I need to figure out, is this the best way? And I just don't know that I would go that far on my own. So that the accountability factor is just way up here
That's a
as
great
far as
answer.
driving me to to the research and the time that I've spent in doing this. So I say, I'm not going to teach forever. I've I've tinkered around with retirement from that aspect of it,
Yeah.
or at least maybe partial for I don't know, the last 2 or 3 years. Um, maybe I've got another 2 or 3 years where I'll do that. I don't know. We'll see. But
There's going to be some people that are watching this that are going to say, Ryan, no, please don't stop.
well, that's why I do the videos, right?
Right.
I
Oh,
mean,
yeah. They
so
can always archive them. Yeah.
and quite frankly, I'll get, I may in 2 or 3 years, I may say, okay, I'm going to hang up the gloves a little bit and I'm
Yeah.
going to focus on my own stuff. And I may get a year into it and say, you know what, I just need it. I need the accountability. It might be that that's the case. I don't know. We'll see if I'm a Tom Brady kind of guy
Yeah.
comes back in
Yeah.
once I try and because I'll never stop watching the markets or trading or analyzing, over analyzing. That'll never stop. The question is, how much involvement am I in the industry? So that'll be it'll be interesting to see.
Well, Ryan, you've got more than one iron in the fire in this
Uh,
industry from different courses and strategies and software technologies and things like that. But there's something that I wanted to actually ask you about today. You were talking to me about it, and you and I were at a meeting, an event, and I just recall we were around a really sharp smart quantitative programmer guy, option guy, and he started asking you what you did. And he started saying, he was using mathematical equations and things like that. And you're like, no, it's simpler than that. And he was like intrigued, and he really didn't even have the mindset of thinking like you were thinking. And it was
yeah,
about this pattern that you're doing and you're teaching with clients, and you're really excited about it. And it's something that I think some people might want to learn about or hear more about. It's a different way of thinking, and I think it might give them a long-term edge in their trading. I mean, because what you found is that personally, and then through testimonies, it's working.
yeah,
So
yeah,
it's the $1 million pattern is what you called it. And if you wanted to kind of get into that today.
yeah. So that kind of is the segue back into the topic today of two mindsets of trading. You've
Right.
got that, and then you've got my mindset, and which is you got to win. But the problem with winning a lot again is what's your win loss ratio, and if your losses are too big, it can wipe out all your wins, and and be just as frustrating. So my approach has been, okay, high probability, but how can you limit the risks? How can
That's
you
it. Mhm.
right? And so this particular strategy, when we were at that meeting, and he starts asking me what a lot of traders may not realize that I don't use Greeks
Right.
when I'm trading options. So my focus is on options as a general rule, because I think that's where you can get the higher probability and the lower risks, right?
Now, Ryan,
Is
let me
is
interrupt.
through option spreads.
Some people are maybe new to this, but when you say Greeks, you don't have to know this, you all, but it's the things like if you want to explain the deltas, the gammas, that you don't really
Betas,
focus
deltas,
on that.
gammas, right? I don't focus on the statistics, the statistical analysis of those Greeks,
Yep.
because I think, well, we could probably dedicate an entire podcast to that alone. So
Sure.
I don't want to get too far in the weeds on that, but I think there's just a simpler way to do it.
Yep.
And
Well put.
I ditched the Greeks back in the 90s. I mean, that's how long ago it was that I stopped using the Greeks, and instead I use the price action alone, not of the underlying, but of the option
Mhm.
themselves. And
Mhm.
so I've created technologies that focus on that as opposed to the Greeks, and
Mhm.
it's just been tremendous. But
Now you're
getting
not, let
back,
me, sorry to
yeah,
interrupt. Now you're
no,
not
no,
saying that the Greeks are useless and some people
no.
do those. You just don't necessarily focus on them. Like I look at a couple of them to help give me a little bit of a possible tiny edge, but they're not the holy grail, basically.
Yeah. I know traders that use the Greeks, and they do really
Good.
well, right?
Mhm.
So I'm not dissing the use of them by any
Yep.
long shot of the imagination.
Good.
For me, I just found that there's a simpler, more logical, easier way to kind of get to the same path, right? And I'm
Right.
all about efficiency. There's, if you get from point A to point B, the quickest, that's the straight line. That's what I'm always shooting for.
Cool. Yeah. Thanks for the
So,
clarity. Gotcha.
yeah. So, with this, so he's talking about the Greek standard stuff of, what most option traders focus on. And I don't focus on that. I focus on the price action of the underlying options, or the underlying spreads of the options, and more specifically. And so I've created a lot of different strategies that focus on that. And I'm constantly trying to get that risk a little bit lower. So, yeah, this $1 million pattern
Yeah.
is kind of what we said, in that conversation I started talking about, because it's one that I've more recently focused on. And quite frankly, it hasn't even been available for that long. Daily
Mhm.
options came on the board, what, about a year and a half ago?
Right.
And it's really a relationship between daily options. And if you're trying to throw monthly option spread mentality onto daily option spreads, forget about it. I mean, it's completely inefficient and completely different in how the two different options interact. So if you're talking about a spread, like just a plain calendar spread, it's going to react totally differently between two different daily options than a weekly and a monthly option.
Right.
So it's only been available. So I have a couple of programs that I use to help find certain patterns, because with daily options now there's just millions of combinations, right? And trying to figure out, okay, which combination do I trade can be an absolute nightmare if you don't have software or something
Mhm.
to help you. And so I had this software built, PDS Trader,
Yeah.
and I started noticing some certain patterns, certain combinations. And then you get into SPX, which has half point strikes. SPY has full basis point strikes, whereas SPX has half point strikes. And so there's just massive number of combinations in SPX. And so you've got to have that software kind of narrow things down for you. So I did, and I started noticing a pattern about a year and a half ago, right after the daily option started, because I was trading Friday, Monday,
Okay.
So it went Friday. First, it was Friday weeklies for a couple of weeks, and then they ended up doing Fridays for every week for the next 6 weeks, and then they added Mondays, and then they added Wednesdays, and then they added Tuesdays and Thursdays. It was a long, 10-year road to get to where we're
Yeah.
at today.
Yeah.
And I started noticing something about this pattern, and so I started trading it off and on, with all my other stuff because I'm trading entirely too many things um, over the last year and a half, and with success. And so finally, I'm like, okay, you know what? There's something to this particular pattern, and I need to spend a little more time focusing on it. And so I started focusing on this pattern. And when I say pattern, I mean an option spread pattern. Like, how far are the short strikes from the long strikes? What are the expiration differences, et cetera. So there's all sorts of combinations. So there are certain patterns. So an iron condor is a pattern, for example. All right. So I have many different types of patterns. So with this, I started focusing this a little bit more in August and September of last year. And with that, I began trading it more consistently. Like every week, I would take anywhere from 6, 7 to 12 trades. So I was trading a lot. There are a lot of opportunities with this particular pattern, and no one should be trading 10 trades a week. It's not day trading, but they're just 10 different opportunities that you can put on. So I started doing that, and from that point to this point, I've taken 157 trades with 5 losses, and my largest loss is
Wow.
190 bucks.
Wow.
Yeah, it's 96.8% win rate. So I've
Wow.
got the win rate down, and there's margin for error there, right? I don't know
Right.
that I'll continue to get a 96.8% win rate. That's impressive.
Yeah.
But the losses, the size of the losses are really what makes this strategy, because I can have a 96.8% win rate, and if my loss is 10 times my average win, you're dead, right?
Correct.
So my largest loss was 190. My average loss has been 65 bucks.
Yeah.
My average win has been 70
And you
per
trade pretty,
spread.
you trade decent size. It's not a really a small size.
Yeah. I mean, when I started, I obviously wasn't trading larger size, but yeah. But we're talking about SPX.
Right.
So that's 10 times the size of SPY. And to
Correct.
pull out a $70, so my average win is 70 bucks in SPX, which is incredibly small. In fact, most people, would look at that and they're like, why are you trading SPX for a $70 gain? Well, because my average loss is only 65. That's why. So it works, right? And
Hmm.
so it's something that you can absolutely scale in SPY. And that's a track record that, honestly, with that large of a sample size, and the market action has not been the best type of market action for this particular pattern.
Yeah.
90, it's been the best risk reward metrics I've ever traded. So 96.8% with a 1-1 win loss ratio over 157 trades.
That
It's
I hate to say this, but that's almost unheard of.
it
It's
is.
rare. It's
It's
truthfully rare if
I've
anybody
never
understands trading.
yeah, I've never
Mm.
experienced it.
Right.
And I mean, I've been doing this for 35 years, and I've never had that kind of track record. So, whether it continues or not. Now, I've noticed a couple of things. I've learned a lot over that 157 trades.
Right.
I wouldn't do all the trades I was taking back in October, in November. I wouldn't necessarily do all of those trades
Yeah.
today. Um, so there's some things that could happen that that win loss ratio gets completely skewed to maybe 80-85%. So
Yeah.
I'm not I'm not under any kind of illusion that I can keep up a 96.8% win rate. Maybe I can, maybe I can't.
Right.
Probably not. There's probably going to be, based on everything that I've seen so far, I might be able to avoid some of the losses that I wouldn't have avoid or I didn't avoid, early on. But it's an interesting pattern, no question, and it's completely different than anything I've done.
Right. Yeah. I mean, I could probably ask you a dozen questions of how this all works, but I don't know if we want to get into the any kind of like feedback or highlights of it, or I don't know if now's the time to do that. Maybe we can talk about that later. But
Yeah, so so
I mean, like, what are you doing? It's kind of a question, or I don't know if you want to get off into that or not.
yeah, I think we can get off into it a little bit because I think it's important, when you're talking about high win rate, you want to avoid the larger losses,
Sure.
right? So there are certain things that you have to do. You can't trade iron condors if you
Yeah.
want to avoid you have to do something a little bit different. So I think it goes right into understanding that you're going to have to do something different than just trade iron condors if you want to do high probability and keep your losses a little bit lower. So let me explain how it works
Yeah.
in, as a general term as I possibly can. Most option spreads you're going for direction,
Right.
right? Some of them you're going for non-direction. You're just going for, straight time decay.
Right.
Um, Rarely can you get both. You usually either have to have time decay or you have to have market direction or some combination of both for most option spreads. And that's the way most of my option spread strategies work. But this one is different because it has nothing to do with time decay. Let me back up. It has a little bit to do with time decay, and it has pretty much nothing to do with market action with regard to how it becomes profitable. So the market doesn't have to move in my favor for it to become profitable, and there doesn't have to be time decay for it to be profitable. Now the market can move and it's profitable, and there can be time decay and it's profitable, but it doesn't have to. That's not the triggering mechanism. And that's what is, it kind of blows people's minds with this approach, because with daily options, what you have is a completely different dynamic in that what's driving those daily option prices are the economic reports
Yeah.
that
Hmm.
are being released on a daily basis. And so what you'll see these wide spreads between a daily option on a day where there's a ton of economic reports and a daily option where there's no economic reports. Right. So
Right.
the one that there's no economic reports, there's not going to be hardly any value there. And so those options are fairly cheap compared to the one where there's a ton of economic reports.
Hmm.
And so what happens is you have these economic reports that are kind of driving this, whether the market moves or not. But as you get closer to the economic reports, you have reactions to that. And so I'll put on a spread, and I'll put on this spread as the price of the spread is contracting. All right. So to give you an example, this very specific pattern, I will wait to put on until I can get it at a credit. All right. So it contracts to a credit. The spread price contracts to a credit.
Right.
And then literally with the market going nowhere and the very little time passing, you will see the price of this spread expand. You'll see it across the board, not just on one option spread, but on the pattern. There might be 10 opportunities with this pattern at any given time, and you'll see the entire group of opportunities, the price expands.
Interesting.
Right? It's truly fascinating, and the more I do it, the more I'm kind of zeroing in on the mechanisms that are causing this. But so what you'll see this option spread. So if this is the baseline, right, you'll see the option spread contract into a buy zone and then expand into a sell zone. And maybe it contracts into a buy zone again and then expands into a sell zone. And so the way that I create the probability is that when it contracts into the buy zone, I buy it and then I do not hang on to it. If it expands into the profit zone, I
Hmm.
will get out. I do not hang on to these trades until expiration. In fact, if I were to hold on to these trades until expiration, the whole metrics will go out the window.
Yeah.
So it's the strategy. It's not the pattern itself. It's how you play the pattern. I want to be very clear about that.
Right.
And people don't realize that that's the same thing with iron condors. You can play them a little bit differently
Mhm.
and create completely different metrics than if you were to play them to expiration, which is what most people do. They play it till expiration. So so that's why it's a very small gain, very small loss, because in the time frame that I'm willing to take these trades, it might go in and out of the uh, expansion, contraction, maybe once, maybe twice, sometimes three times, depending on how soon it goes into the contraction period. So if it waits until closer to the end, towards the expiration, to go into that contraction period, it might, um, it might be a day before I need to get out, and that means there's only going to be one shot at it, and so I take
Hmm.
that shot, and as soon as it expands, I get out. Now, where the risk comes in this particular strategy is that it goes into the contraction area and then never comes out. So
Okay.
every loss has happened because of that scenario, and there are certain events that have to happen that will cause that to happen. And and I have a strict rule that I do not hold on until expiration. And that is what helps me create the higher probability and the win loss ratio that is in line with what you have seen. And so if we get to, let's say, the day before expiration,
Hmm.
and this is not in the expansion level, I may
Right.
be taking a loss, or maybe a small win or break even or something like that. I will take the loss. I don't care what happens the next day. The metrics on the last day are just different, and you don't want to take that risk. So it's not just the pattern itself; it's how you play the pattern that creates the probabilities. And it's been fascinating to watch. That's for certain.
So this is cool, Ryan. So let me get this straight for layman's terms. So you created a software
Yeah.
that helps find these patterns for you. And then in regards to managing the trade, do you have to stay glued to the computer all day or any of that kind of stuff? Or do you have
No.
something that helps you manage it, or how do you do that? I mean,
Yeah. So I'm gonna show you. So the great thing about this is that you can come in the morning, kind of get a feel. Okay, here are the opportunities, and
yeah.
I'm going to go for a certain price. And so I'm going to anticipate the contraction a little bit,
Okay.
and so I'll put a limit order in. If it gets filled, it gets filled. If not, it doesn't.
Yeah.
And then I'm going to anticipate. Okay, based on what I see in the overall matrix, and I'm going to share my screen here for a second,
Okay.
and just kind of show you how this works.
Okay.
But I'm gonna kind of guesstimate what when it expands, what it might expand to, if, at a high probability. I'm not looking for the maximum expansion level. Um, Hang
You got
on
a
one
trade going
second.
on. You got
Now,
that look going on like you got a
yeah.
trade.
um, there we go. So, with this,
Hmm.
the uh, the price of the spread will expand, and I'm going to go for a high target, and I'll put that limit in, and I'll just sit there. And if it's not hit by the end of the day
Hmm.
of when I got to get out, then I'm going to implement what I call a smart fill process, and
Okay.
that's basically where I've got a software that does this for me, a trading
Okay.
platform, and anybody can get it.
Okay.
It's
Gotcha.
called Trade Partner, and what it will do is it will put in the exit order at a certain price, and if that's not filled within however many seconds or minutes that I have it set to stay in, it will cancel the order and replace it with the next price
I gotcha.
until it gets filled.
Oh,
And
that's cool.
so,
Yeah.
yeah, so You don't need to watch it. It's not, there's no market watch or anything like that, but you do have to make sure you're out of the trade when you need to be out of the trade. And this is really fascinating. I don't want to get too far into this, but I'm going to share my screen
Okay.
and let me see here. See if it works.
Okay.
Hopefully it works. So I'm going to give you an example of, um, I've got 6 screens, by the way, so I'm going
Yeah.
all over the place here. I'm going to
Okay.
share screen, and
I'll let you know. Get it in here.
so right now you should be able to see the screen.
Yes.
All right,
Got it.
so this is what's called an option matrix. No other platform on the planet produces these matrices. And basically, this is an option chain. It's the same as an option chain, only instead of single legs, it's a spread option chain. That's the easiest way to explain it.
Mm-hmm.
And so what you see here is I covered up the legs. I don't want to. People should not trade this without knowing what they're doing. And so
Okay.
I don't give this away without people learning it, right?
Okay. Yeah.
But just kind of give you an idea. This is one example of a group of spreads in these set of strikes that have all contracted to credits. Can you see that?
Yeah. So on this platform, so people know, and I want to make is when you see a red number, that's a credit.
That's a
Like
credit. Yes.
that's a credit. Okay. Gotcha.
Yes. Right.
So a green number would be a debit to
A
do the
green
trade.
number would be a debit. Correct.
Gotcha. Okay. Wanted to make sure
And
people understand, and I do as well.
yep. And so the top column here are the expiration dates. Now, this spread is actually a 2526. All right. So this is showing the expiration of the short. So the 25 means that the short leg of this spread expires on 25.
Gotcha.
And in this particular example, the long leg expires the next day, which is 26. All right.
Gotcha.
So this particular pattern in this strike range are all producing credits.
Mm-hmm.
And this is 15 minutes after the open on 2-2. So this is the day before this particular one expires. And I'm in from the day before at a credit of 55. Okay. So this
Okay.
particular one that I've kind of highlighted is the one that I took. And this is you'll see that there are credits here on the 2-6 column. There's credits here on 2-8 columns. And I've
Yeah.
taken trades. I took trades in both of these. And you're even starting to see some credits form here in the 2-7 column. This is
Mm-hmm.
why I say there are multiple, dozens of opportunities, potentially weekly. And so I've taken one here. I took one on this column and then I took one in this column. But I'm going to focus on this one first. 35-cent credit. I was filled at a 55-cent credit. And so 15 minutes after the open the next day, it's trading at a 35-cent credit. So technically I'm making $20 on this trade, right? That's and this whole group are trading at credit. So I'm going to just fast forward this just a little bit. This is 90 minutes after the open. And what you're going to notice is that, okay, the one that I was talking about, the 498.50 here, it's now trading at a 15-cent credit. So you're starting to see an expansion of the prices. You also see that the number of rows that have credits is also contracting, right? So as the price of the spreads expand, the number of credits that are available are starting to contract. You can watch this literally happen, before your eyes on some days. So that's 90 minutes after the open, it's starting to contract. Here is 2 hours after the open. So just 30 minutes later, and all of a sudden now the spreads have started to contract again. And now you've got a bigger credit showing. Here's a 70-cent credit. The largest credit at 15 minutes was only 57 cents. Now at 2 hours after the open, you actually have one that's showing at a 70-cent credit and a 75-cent credit, and 65-cent credit. So now you have them contracting again 2 hours after the open. And then just 2.5 hours later, 2.5 hours after the open, so 30 minutes later, all of a sudden now it's expanding again.
Mm-hmm.
Right? You see that?
Yeah.
And then 10 minutes after the last screenshot, all of the credits just disappeared. And the market basically went nowhere.
Interesting.
It is fascinating. And you'll notice the number of credits in the 2.6 column have
Yeah.
diminished and have also expanded. There's nothing in the 2.7 column, and there's nothing in the 2.8 column all of a sudden. They're
Right.
all debits. So if you get into any of these, 15 minutes after you open at a credit,
Yeah.
and 2.5 hours later, with the market going nowhere, they're all at debits. That's what this is doing. It's the most bizarre thing I've ever seen. And no one knows about it because you're not going to notice it if you don't have this matrix, and no one has this matrix. And so it's a fabulous thing. So I took a profit on this at a debit of 5.
Okay.
So I took a $60 profit on this particular gain. And again, I was projecting, and I needed to be out the day before, and so I needed to be out that day anyway. So I was being very, aggressive with, getting out. But notice here's 10 minutes after the last screenshot. So that's not 2.5 hours, but 2 hours and 40 minutes is after the open.
And you,
And
you had
then
$5 of risk.
do what?
You had $5 of risk on that
Well,
day.
that's so no, you can't really say that
Okay.
because they can continue to contract, right? The prices don't have to expand.
Right.
Again, I'm dealing more, I'm getting more and more into the mechanisms that are causing the contractions and the expansion. I'm trying to hone that a little bit, but
Right.
this is 2 hours and 40 minutes. This is 15 minutes later. So this is
Wow.
just over 3 hours. And notice my initial target that I had on this trade was $100, but then we get to the last day that I'm willing to be in the trade, and
Yeah.
I lower that target because I really got to be out.
Yeah.
But my original target would have been hit at
Okay.
at 45-cent debit. So if I got in at 55-cent credit, get out a 45-cent debit, that's $100 gain,
Yeah.
right? But again, all of these credits have gone to um, debits, and this is within a 2.5 hour period. Now it doesn't always happen like this. Sometimes I'll
Yeah.
be in a trade and I won't see the expansion happen for 2 days. Right. So I think the hardest part about this is that one trade that works one way one week will not work the same way the next week because the quite frankly, the economic reports are different. And
Right.
so that just kind of gives you an idea. And if you don't understand the matrix, that's fine. I think everybody saw enough to understand, how the
Has
price
this
is.
become second nature to you? Because we all have like what's called procedural memory. So once you start doing things over and over and again, you can, as they say, do it in your sleep. But when you're first looking
Yes.
at it, you're like, huh? So
Yeah. Yeah. It is because it's different. Like I said,
yeah.
the whole industry has you focus on Greeks, and no one has the matrix. No one has the software that combines all of the different combinations that are possible, and then gives you the
Right.
risk graph, like PDS Trader does. So this is new to most people because the tools out there and the approaches that are pushed, they're just not something that the industry is really has a whole lot of interest in.
Yeah. Well, this is really interesting to me from the simplicity standpoint of risk reward. When you're saying that in general, of course, don't quote me, this would obviously not a guarantee. When you can win upwards of 80 or 90+% of your trades and arguably average risking one to make one, that's pretty phenomenal, Ryan.
Yeah,
It's
yeah,
definitely
it is.
unique. If people have been around a long time, that's not normal, you
No,
know?
it isn't. It isn't. And again, it's in order to create those kind of statistics, you really have to look at not just the underlying spread, but how to play the underlying spread. And I think that's what a lot of people miss, because everybody puts up the last day risk graph. I do
Uh,
this. I put up the last day risk graph,
mhm.
but I don't play it for the last day. In fact, very rarely will I hold on to any of my strategy spreads. The $1 million pattern approach, or my combination, or my cash flow combination, I rarely hold on to these trades until expiration. And so it's not just the spread, it's not just the pattern, it's how you play it that really
Yeah.
affects, what you're doing.
So this is interesting. So you're really playing these around economic reports, two or three of these a week on average, maybe more. I'm not really sure. But so once you get it dialed in, do you have to spend a lot of your time doing this, Ryan?
Well, I spend a lot of my time doing it because I'm constantly analyzing, right?
Right.
I'm watching these so that I can learn and, get a good feel for, okay, what's really happening. And then
Right.
once I understand what's really happening, I start trying to look for the mechanisms that are causing these things to happen. So I do spend,
Yeah.
an inordinate amount of time.
Right. But yeah, you
um,
have the time and you enjoy doing it, and it's your
well,
life, a big part of your life.
yeah, it's my life. And again, people are trading these signals. And
Well,
so,
that's true. Oh, you're giving signals to people.
yeah, 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 yeah. So
Oh,
I
so you're
started
doing
giving.
all the kind of the work and homework, and but you teach them the foundation of how to
I
manage it, or how does this work?
so I have a course. It's called the $1 Million Pattern course, where I teach the logic. I show you
Uh,
the patterns. I show you the different variations of the patterns and whatnot. So I teach everything about it. I don't hold anything back because I think the more the trader understands what they're trading, the more successful they're going to be able to implement it.
I got you.
But then I also show you, okay, here's the logic, um, and here's the actual implementation of that logic through these signals. And so I started those back in mid October, and I give 1 to 3 signals a week.
Okay.
So we're not trading, 10 to 12 trades. So the example that I gave just a minute ago, that was actually one of the actual signals
Mhm.
that I given. And so, in those, we've taken like 12 trades and had one loss.
Okay.
Since I
Well,
started those signals. And so it's really boring and really slow, but I also give the compounding plan, and that's really where the money's made. It's in scaling. As you're doing well, increase your trade size, and it just becomes astronomical. That we can, we'll
we'll talk
probably
about
devote a
that
whole
again.
podcast to that as well at some point. So
Yeah, what's interesting is, me and you've been talking about this for years, and I actually was a client of yours many years ago because your background is around the money management. I don't think a lot of people understand that actually the less risk you have, the more aggressive you
yeah,
can be with the compounding if you understand how to do it properly.
yeah,
And a lot of people, 99% of traders out there just have never learned or been
it's the
taught.
key. It is the absolute key. In fact, it's the driving force behind me trying to find the types of strategies that I'm trying to find, because the lower your drawdown, the more efficient you'll be able to compound. And so that, knowing that, that's what drives me into finding a certain type of strategy, or creating a certain type of strategy.
Mhm.
And that's what led to, this one, certainly.
Cool. I wanted to ask you, and I know you got a piece. So you give people the trades. Do you email it or text it to them? And I know you have like a platform. Can they come to their How does that work?
Yeah. So, tradepartner.io is where you can get a free version of the platform for a limited
Yeah,
time.
yeah,
And I actually give the signals exactly as I'm taking them in the platform. And so when I take a signal, it
uh,
pushes that to the other platforms. And
uh,
so it shows up on their screen, and they can either just say, yeah, I want to take that trade exactly as it is, or they can make adjustments, or, change the trade size, or, they can do whatever they want.
yeah,
But it comes to them exactly as I'm taking it. And all they have to do is push a button.
yeah. And it just
And
executes through their
yeah,
broker.
just executes to the broker. That's correct.
Okay,
So
and I guess people are pretty happy with that.
they are.
Yeah,
I mean, you tout a big track record, and then all of a sudden the thing breaks. How often does that happen, right? So,
yeah, yeah. We've
you know,
all seen.
we're carrying on the probability. We're carrying on the largest loss in that particular signal service has only been 130,
Okay.
$130.
Mhm.
Um, so, it's actually doing a little bit better than my overall track record.
Yeah, yeah. Well, that's cool. Very
Yep,
cool. Well, man, I think we've talked about a lot of things.
we have.
So I was going to ask you too. By the way, I probably need to start looking into this more. Can I get started with a pretty small account, trying to do
Yeah,
what you're doing, or what do you? How does what's your kind of recommended baseline to get started with it?
the margin for one spread in SPX is going in this particular pattern, for example, is $2,500.
Okay,
So
so 20,
you're going to want more than that. So I would say 5,000. You can do one spread at a time. If you want to take if you want to take more than one spread, obviously you're going to have enough margin to take, possibly two or three trades. You need 7,500 to $10,000. If you want to follow the compounding plan,
Yeah.
however, because
Yeah.
I do give away the compounding plan,
Okay.
which now I don't want to go into what can be made with the compounding plan,
Okay.
but and not in this podcast, but um, in that particular scenario, if you want to follow the compounding plan, you need to start with a little bit higher account.
Okay.
Otherwise, you're gonna increase faster in trade size than the margin is going to allow you.
Uh-huh.
And so you either have to slow down the compounding based on your account size, or you need to start with a little bit more. So about 25,000, you can start with one and then increase as you're experiencing success,
Right.
and you can follow the compounding plan and create geometric growth in your account.
Well, let me ask you this. So if I have 25,000 in an account, that money's not all at risk.
No, 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 no. You're
Oh, okay.
taking
Yeah, I didn't think
that.
so.
That's just to account for the eventual increase in your trade size as you're experiencing success.
Right.
So
Gotcha.
we're kind of your risk your risk is going to be very limited. Your
Well, I
margin
think
is
that's
twenty
great
five
for
hundred
people to
bucks.
know. Like,
Yeah,
I got to
yeah.
put up 25 grand. Well,
No,
that's
no, no,
not
no,
at
no,
risk,
no.
really. I mean, or
Yeah,
5,000 for that matter. It's not.
yeah. So let me kind of explain that real quick, and then we'll go ahead and end this. But
Okay.
um, 5,000, you can trade one, or maybe you can trade two.
Okay.
And then if you're doing well, you want to go to three, but you may not have the margin yet to go to three. So
I
it's
got you.
going to stop you. So what I'm saying is if you start with 25 and then as you do well, you increase your trade size, that margin's not going to stop you from increasing trade size. The margin limit is not going to stop you from it. And following that compounding plan is what I'm saying.
Gotcha. Gotcha.
Yeah.
Well, man, Ryan, this has been some interesting stuff. And
Yeah.
again, like to go back to revert back to the traditional trading, what 95% of all traders do in regards to trying to pick direction and the low odds of success with that over, picking trade probabilities. It makes sense to, I think, probably consider doing more of what you do. You just
Well,
got
I
to take
think
the
I think
time.
everybody, if they had the choice, would do
Yeah,
that. But
yeah,
it's harder to do than it's harder to do than it might first seem. And that's kind of what I've spent my trading career focused on, though. So
okay.
yeah,
Well, Ryan, well, good stuff, man. Thank you for your time. Everybody, thanks for your time for listening to us jabber on today. But it was
yep,
really
yep.
good stuff. I mean, really,
Good,
really
good.
interesting stuff. I'm gonna have to dig into this stuff more, Ryan, and learn about it myself. So, thanks for your time, man.
Yeah. Hey, thanks for having me, and we'll see you next time, huh?
All right, sounds good.
All right. Take
All
care.
right, take care.